You can design systems like long-term capital or whatever that can give you smooth returns for a while, but what those systems are doing, in my opinion, are what I call warehousing risk. You can design a system that essentially accumulates risk in some sense, and that when it finally breaks out, it happens in a big way. That's what I think like a trend follower tends to do, is I'm taking risk on an ongoing basis. I'm realizing risk. I'm not warehousing it. I'm recognizing it and realizing it, and that's just part of the game. And I think any sort of viable long-term investment has to do that, because otherwise it's a disaster waiting to happen. This is Bill Dreiss, President and founder of Dreiss Research Corporation, and you're listening to Top Traders Unplugged.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup Larsen.
Which is highly technical. That's also provides a certain amount of credibility in terms of my track record. In other words, I have NAV doing that, and so it's not like people might suspect that I'm, fudging my performance.
There's one question though, Bill, that I have to ask, and obviously being a little bit frank about it, but as you've explained, people would have guessed now that you're not in sort of the youngest part of the CTA space. You've been around for a long time. So what's your thoughts about who's gonna take over the day you don't want to do this anymore? I mean, are you thinking that far out and saying, yeah, I want to, because, I use it as an example, the firm that I work for, Dunn Capital, it's also been around since 1974, but we've gone through the succession planning and Marty Bergen is the owner and run that firm. How do you think about these things? Because I'm sure investors will be thinking about it as well.
Well, I've been exploring various possibilities of passing my business on in various ways, and of course there's the alternatives are I could sell it, or I could form a partnership with someone who I could pass it along to, and so on and so forth. So I have been actively exploring that. At this point, I haven't really made any decision as to what the best way to go, but it's certainly on my mind.
Good. Anyway, let's jump to the next section. I want to talk a little bit about track record now. I'm not here or we're not going to here to talk about specific numbers or anything like that. Regulation makes sure that we're not allowed to do that. But I do want to ask you a little bit about track records in general. Now, again, your track record is very long, and although you've said that your system hasn't really changed over time, that obviously should give a lot of confidence when people look at track records and your track record in particular. But I mean, is there anything people should be aware of in terms of things that has improved and made significant improvement along the sort of the last 25 years, you would say, or is it really, we started in 91 and it's pretty much what you're looking at, what you would have gotten, whether you made any changes or not?
Well, things always look better in retrospect, because, whatever modifications you make over time, generally, if even if you're not doing those based on back testing, tend to look better, going back. But no, I would say that really not much has changed. In other words, the system has been pretty stable over the years. I would think that the main sort of changes that have been made have been involving adding or changing the portfolio, adding or subtracting various markets, and those judgments are made generally on, once again, more economic grounds or qualitative grounds. In other words, if a market becomes inactive or because say something like short-term interest rates in Japan. I used to trade the euro yen. It just, things go dead and you say, I'm not going to trade that anymore. But by and large, even the portfolio, even the commodities I've traded have stayed pretty much the same. Now, that having been said, it's amazing how much, say, dropping a particular market out can change your profile, at least in the short term. So small changes can very frequently show up as fairly large influence on your track record, at least in terms of the shorter term. Obviously, over the longer term, they don't make much difference.
Sure. Now, one of the things, of course, having been in business for a long time and having studied the market for an even longer time, is that you've seen a lot of data, you've seen a lot of different market environments. You mentioned earlier on that periodically people will say that trend following is dead and all of those things. But one thing I don't think we can ignore, and I wanted to get your take on it, and that is since 2009, there certainly has been a bit of a concentration of what could we call it, below average returns in terms of annual returns for CTAs. At the same time, we've also seen at least one very solid year in the last couple of years. So, but there's to me a little bit more inconsistency in this overall CTA returns. Do you think that something has changed since 2009? And we all know, the reasons why that might be, or is this just something that when you look back at your data that this is really business as usual?
Well, I would say the most obvious breakpoint, if I look at my past performance, came around the turn of the century. And I think prior to that, and this goes way back. I mean, one of the justifications for CTAs or for diverse was the fact that in commodities you could presumably get diversification because you had all these markets that had different fundamentals, right? Why should cattle move with copper or wheat? And so I think certainly from the 70s when I got started into probably the end of the 90s, you had a reasonable amount of diversification between markets. Or non-correlation between markets, and of course, it varies depending on market conditions. But since then, the correlations have increased, not just between financial markets, but between commodity markets and between financial markets and commodity markets. And I think that really became even more pronounced during and after the crash, when things became almost in lockstep. I mean, that's one of the reasons why why most CTAs did so well in the crash, is that everything, diversification, it's like Mark Cuban says, diversification is for idiots. But in a sense, diversification is either or I should say the lack of diversification, that is the correlation, can be your friend or your enemy. If you're in the right direction, you make a lot of money because everything's moving. And obviously, if you're in the wrong direction, then that's when you take drawdowns. So I think that's what we've seen since, as you say, 2009, or maybe since 2008. We've seen the potential for much larger moves, either in the positive direction or the negative direction. I'd say since 2009, certainly, or since my returns, at least my average returns, are about the same as they were before. But I've had 2008 and 2014 were by far my largest yearly profits, whereas 2013 was my largest drawdown. So, it's a double-edged sword. So I do think the markets have changed in that regard. I don't know what to do about it.
No, I agree with that. I mean, I think you're right. And, correlations have certainly, changed in some ways, and markets are, more interrelated in that maybe we've seen some years back. And I wonder, hopefully things will, I think maybe markets are becoming a little bit more divergent again, which is what we really want, I think, as CTAs. Volatility is good, but divergence and volatility is probably even even better?
Well, I think that you could see that from sort of the end of 2013 into the middle of 2015 for about a year and a half. The volatility went way down.
Yeah.
Certainly, and the correlation, and at the same time, I think the correlations went down.
Yeah.
That is, you started getting markets moving on their own.
Yeah.
But sort of since the summer, I guess, we've started to see those correlations, and now now it looks like everything's moving with oil. So so I think that this was observable as far back as I think the .com boom.
Yeah.
When the markets really start getting volatile, it doesn't matter which market segment it is, things tend to snap into place and your correlations pick up. So whether it's the stock market, driving things, or whether it's the oil market or whatever, once the markets become, one segment of the markets gets volatile, then it tends to drag a lot of other segments along with it.
Yeah, no, definitely.
And I don't know whether that's globalization or whether it's, the big banks. I mean, you could think of all sorts of reasons that these things are, why these correlations are heightened, but that just seems to be the environment that we're in.
Sure. Well, luckily we're in a strategy area where we don't have to forecast, as you said. Reaction to whatever market conditions we get seems to still work quite well. So let's talk a little bit about the strategy and the program itself. If you were going to describe sort of to a potential investor from a 30,000 feet point of view, what you're trying to achieve in terms of, I don't know, perhaps risk reward, or I don't know what kind of way you would normally describe it. You obviously mentioned that you're in the higher level of perhaps risk compared to some of the really large firms, but how would you describe what you're trying to achieve to a potential investor?
Well, I think that one thing that's always motivated me, and partly is just the matter that I've never really gotten, or partly this is due to the fact that I've never really gotten that big, is I like to give investors a bang for their buck. So in other words, you can leverage down, but now if you're charging people 2 and 20 or something, and you're trading them at 10% margin on equity, it seems to me that you're not really giving them their money's worth. Of course, now I just charge incentive fees, so the management fee doesn't come into play. I think what you're looking at in general, if you're looking at fairly, there's, I don't know how to say this, there's a standard in the industry or in the financial industry of about 20% return. And that's what Warren Buffett makes. That's what anybody who's been a successful investor, meaning a knowledgeable investor for a long time, they make the 20%. Very few people go over that. And the people who go under it essentially are going under it because they're reducing their leverage and just provide. So essentially, the product that I'm offering, or that people say in my risk range are offering, is the ability to make, over a long term, maybe 20% or so a year, 15 or 20% a year, but they've got to be willing to take some drawdowns. It's, like Warren Buffett said. He said, if you can't take a 50% drawdown, you shouldn't be investing. And of course, people take those kind of drawdowns all the time or not all the time, but in real estate and in other investments. If the last real estate bust, how many properties went down by 50% or more? But people don't care. They just hold on. And so if you can convince people to hold on through the drawdowns and commodities, then you've got something that I think is, just as attractive as other investments, maybe even more so. I mean, you can certainly get 50% drawdowns trading the stock market without much effort.
Sure. I want to talk a little bit about the environment as well, because a lot of investors may not appreciate that any strategy, you mentioned a few, including your own, there is a certain environment where it works well. There's a certain environment where it's not meant to work. And of course, we're all trying to in some ways differentiate between the good times and the bad times to create a more robust output. And I came across something in the literature I read about you, which referred to a choppiness index. And I don't know whether it's designed to do what I just tried to explain in terms of protecting you in the difficult times and allowing you to maybe be a little bit more aggressive in the good times. But explain to me a little bit about the choppiness index.
Well, I looked at, I know what you're alluding to. The temptation is to say, well, okay, if I could find something that would tell me when I'm in a choppy market, then I'd reduce my trading, and if it tell me when I'm in a trendy market, then I could increase my trading. Well, I don't know. I can't do that. About the time you've identified that you're in a choppy market, it's time for it's about ready to take off again. The choppiness index is really a fairly short-term indicator that just tells me what it allows me to do is to move my stops up if I have a market that's starting to run away. So if you have a market that's blowing off or that's really accelerating, it
like oil at the moment to the downside, perhaps.
Yeah, that's right. And in fact, it's kicked in on some of those petroleum markets. But essentially, it's just an indicator that allows me to move my stops more much closer than they would normally be.
And did you have that from day one, or is that something that you've discovered?
No, that's something that sort of way back. Yeah.
Okay.
It's just another aspect of the system. So it's an override, as it were. But it's systematic. It's not. There's no judgment involved. It's just part of the system. It essentially isn't something that's indicating that the trend is accelerated and it's time to maybe tighten up my stops.
Sure. You mentioned also earlier on, obviously a lot of people refer to, trending versus mean reverting. You were referring to persistent, and the back side of that is anti-persistent, of course. And you said that this is something that you can kind of prove when you look at markets, et cetera, et cetera. But if that's the case, and we believe that over time that trend following as a strategy is more likely to succeed in the long run compared to mean reverting or any other sort of anti-persistent strategy. Why do you think it is so difficult for investors to see that evidence? Because I think that there is a tendency for people to prefer the mean reverting strategies. They feel better about it. They have more winning months, perhaps, until, of course, we know from other firms that, you get perhaps a blow up at the very end. So why can't we visualize this better to investors?
Well, I think it all comes down to Kahneman and Tversky, behavioral economics. I mean, there've been a lot of research done on the actual psychological responses people in these kinds of situations. So, one thing I think about is what I do and what anybody who's sort of what a professional investor does is he is essentially working against, in his own psychology, he's working against those behaviors that are typical and pretty much pervasive human behaviors. And to some extent, that's how we make money. We make money by taking advantage of people who are subject to those kinds of, shall we say, irrationalities. And that's why I was saying before, that's why it was so easy back in the 70s to make money as a systems traders, because almost everybody that you were trading against was very much subject to the vagaries of fear and greed, and you were insulating yourself from that to some extent. So, that's pretty much the same situation here. I mean, as we all know, the client is his own worst enemy. No matter how, over the years, you watch people come and go, and people are inclined to come in at the top and leave at the bottom.
Sure. What does the portfolio look like today? In terms of markets, how many markets do you trade? And is it? I understand that it is fully diversified, but commodities is an interesting sector. So how much of that do you have in your portfolio today?
I tend to be, and this has always been the case. I tend to be probably overweighted in commodities compared to most people. Right now I'm about 35% financials and 65% commodities. I'm trading about 42 markets at the time, but usually I'm right around 40 markets. And as I say, I try to diversify across sectors, not just markets, so that I'm not too heavily weighted in any particular sector. It's hard to avoid that to some extent just because you have more markets available in some sectors than others. But I think, say, if I were to say what differentiates Dreiss Research from other, say, trend-following CTAs, I would say that I'm probably more heavily concentrated in commodities versus financials. And of course, some of this has to do with size also. When you get into the large CTAs, the liquidity's in the financials for the most part, and so they have no choice but to move in that direction.
As well as time frame, I think that's probably the other differentiating part. I would say when I listen to your explanation. I mean, people have probably become more medium term, but you've stayed long term as has a few others, and that seems to have served them well.
Yeah, and that's another good point, because if you're dealing with markets that have less liquidity, it's less of a problem if you're trading long term. If I have fewer trades, then I care less about how much slippage I get when I make a trade. If I'm making lots of trades, then I want to have a lot of liquidity just so I don't get hammered by the slippage.
How do you enter a market? Meaning, does the system kind of get one signal and then you're fully into the market, or does the fractal methodology kind of build up over a period of time in order to get fully invested in a market position?
No, I enter all at once, and I've obviously, I mean, a lot of these strategies, there's a lot of different options in this sort of thing that, different people do different things. I've researched it. My conclusion is simple is better. So I just I trade with stop orders and get in all at once. If you wait to get in, you're probably, if it's a good trade, you're too late.
That is true.
If it's a bad trade, you wish you wouldn't have got in.
Yeah. Speaking of entries and exits and sort of position management, I don't know, my own experience is I think a lot of managers, regardless of methodology, tend to identify the beginning of the trends around the same time, where personally I think there could be more of a difference between managers is, one, how they manage the position along the trend, and also where they get out. But, it's not scientific, it's just sort of my gut feel. How do you view these sort of entries versus exits and the position management? And how do you manage your position along with the trend?
Well, one thing I do that, as I say, from the point of view of my system, that is the signals that say, one, I'm not a reversal system. So my entry and exit signals are different. Not always, but most of the time. But I just take one signal. But what I do is I try to maintain what I call risk balancing. That is, I try to balance my positions based on dollar risk. And of course, that changes with the volatility. So if the volatility of a position picks up, then I'll pare down that position to keep it in balance with my other positions. So that has two effects. Obviously, it keeps it, like any kind of form of portfolio balancing. It means that, I don't become overexposed in any particular market. Or on the other hand, what it means is that generally, if I'm into a long trend and the market's moving in my favor, generally gets more volatile as time goes by, and so I'll be paring my position as time goes by. And again, this is not explicitly built into the system, but the effect of this is that I tend to sort of take profits on a position as time goes by. Not to say that my position gets pared down to a very small position, but generally I'll pare the position down over time. And so even if I get to the end of a trade, sometimes I'll get to the end of a trade and then I'll have a very sharp reversal coming back. But I've still sort of taken some out of that market, prior to that time. So that helps a bit.
But you wouldn't be able to get out completely as long as the trend is going in your favor, right? Or,
no, not at all. And in fact, I would almost always maintain the bulk of my original position would be intact until I get an exit signal.
Yeah. One of the questions I get a lot of at the moment from potential investors and also people who are listening in terms of interest in system development and so on and so forth, because they hear a lot about that people will, look at the volatility when sizing their positions, etc., etc. We've now had a period of time where certain markets have been a lot less volatile than others because they've been artificially managed by central banks. So how do you handle that in order to avoid that your system recognizes this as a low risk opportunity, but it obviously may contain a lot of risk? It's just that the volatility in, say, short-term interest rates, maybe bonds, whatever it might be, could be argued is artificially low at the moment. How do you approach that?
Well, I just don't acknowledge that. To me, the volatility is what it is. That is, I look at, I have a measure of volatility, which again I guess it would be parameterized in the sense that I mentioned before. So I have a certain look back window and that relates to the dynamics of my system, and then I calculate the volatility. And if the volatility is low, then I'll get into a larger position. If the volatility is high, I'll get into a smaller position. And then as the volatility varies, as the position develops, then I might scale down if it grows as time goes by. But these are all, the effect of all this is to pretty much maintain a dollar volatility in the various markets to be pretty much equivalent over time.
You also mentioned you use stop losses, and I was just curious, is it the fractal nature of markets that tells you where the stop should be, or is the stop algorithm or methodology completely separate that you've just developed over the years?
Well, as I said, the main function of the fractal wave algorithm is to essentially define turning points in an objective way or in a non-subjective way. And then what do you do with those? Well, what I do with those is pretty much the same thing that any technical analyst would do. I use them as trend lines, and then if I when I break trend lines, that gives me signals. And I also use them as support and resistance, generally in the shorter term. So I use sort of a combination. In other words, if I get a trend line break, I also want a short-term break of a support or resistance point. So that's why I say I use, in some sense, if you were to observe my system, on a chart. In other words, this whole thing comes out on a chart. It looks like pretty standard technical analysis. The difference, of course, being is I'm not making any judgments on that. I'm just the system's making the judgments, but it has the look and feel of what you'd see, what you get from technical analysis.
Let's shift gear to a very important topic, namely risk management. How do you define risk? I know that you are not a big fan of standard deviation. So how do you define risk in your own methodology?
Well, I think again from my sort of philosophical position, I'm very suspicious of any kind of things like VAR or any kind of the standard risk metrics. I just think that risk is out there, and your worst drawdown is always in the future. And I think if you look back over time, you find again some pretty standard risk profiles. When you look at anybody who's been around for say 20 years or so, or maybe even 10, almost every one of those managers has had a major drawdown, by which I'd characterize as 50% or more, and usually just one, right? I was fortunate in that mine didn't happen until 2013, so I went for a long time and living a charmed life in a way. But, anybody who's been around for a while has had one of those catastrophic drawdowns, and in some cases, those are called blow-ups, and they go out of business. Somebody like Richard Dennis did it 3 times, I think. if you can live through those, which again is much more a function of how well your business is run and how stable your client support is and how dedicated your marketing team is. If you can ride through those, then you can come out the other side. Okay, so I'm sort of getting off the subject, but as far as risk goes, no, I think the risk profiles to some extent you can over manage risk. There's just some things you just have to accept and you can't really control. And I think the most important factor that has to do with risk is whether the manager is going to lose his head or not. The people who've survived in this business are people who've been able to weather those weather drawdowns without losing their nerve. That's exactly it. And so that's where the risk comes in. The risk comes in, is your manager going to lose it? That's for the ultimate risk. And if you believe that your guy's going to stay the course, then you should probably stay the course too.
So am I right in saying that from listening to what you've explained so far, that risk is really something you look at market by market, and that intra-market correlations per se is not going to change the way you size the position in one market, so to speak, when an opportunity arises? Or is that a fair way of describing it?
Well, I don't think say risk in terms of I'm obviously sizing my position market by market based upon volatility. Yeah. So you're using risk in a different sense. If you're talking about portfolio risk, then that's a different topic, shall we say? Okay. And it has to do with how the markets interact, and as we say, if they're highly correlated, then there's a larger risk in the standard deviation sense. That is, there's a larger variation, right? But once again, I don't believe, that's not something you really have anything but sort of the grossest control over. You're controlling that in some sense by the amount of leverage you're taking. But to think that you can manage that in some sense, I think, is illusory.
Yeah. No, that's fine. Now, you mentioned yourself that all managers go through a drawdown, and that you've been there as well. And obviously, managers who've been around for a long time have gone through many drawdowns, maybe not as big as a 40 or 50%, but there will be drawdowns, along the way. Now, I'm going to quote someone that you may be familiar with, and who wrote a few years ago. It's David Dreiss, and he wrote a few years ago that here's an amazing thing about robust systems. The more robust a system, the more volatile it tends to be. This is because robust systems are not optimized to particular markets or market conditions. The converse is also true. You can design systems with excellent returns and low volatility on historical testing, but which work only for a given period or given market. These systems tend to be curve fit and market fit and not robust. Now, this is completely probably against what most people will feel, that robust systems are the ones that are more volatile. But I sense from our conversation today that that's a conclusion you've come to as well.
Yeah, well, I know David, and he's right. And I think this is a conclusion that most people who've been in the business for a while would come to. And it's what I call, this is in contrast to perhaps the dominant quant paradigm, which is, picking up nickels in front of a steamroller. In other words, you can design systems like long-term capital or whatever that can give you smooth returns for a while, but what those systems are doing, in my opinion, are what I call warehousing risk. So essentially, it's like, and I think it's the same sort of thing that Dave is talking about. You can design a system that essentially accumulates risk in some sense, and that when it finally breaks out, it happens in a big way, and this is, of course, what happened in the lead up to the financial crisis. You had all these people, developing these securitizations and all these sorts of things, and it was they were just setting the system up for a major break. But in the short term, while that was going on, everybody was happy because everybody was making money, and the apparent risk was very low. that's what I think like a trend follower tends to do, is I'm essentially, how do you say this, taking risk on an ongoing basis. I'm realizing risk. I'm not warehousing it. I'm recognizing it and realizing it, and that's just part of the game. And I think any sort of viable long-term investment has to do that, because otherwise it's a disaster waiting to happen.
Sure. A lot of people say, you hear entrepreneurs talk about it all the time, that they learned a lot from the adverse time in their career and so on and so forth. What about drawdowns? What have you learned from your drawdowns? Maybe have you learned anything from the big drawdown you had more recently that was different to what you've seen before?
No. There's two kinds of drawdowns. You said certainly there's the garden variety drawdown, which for me might be 20 to 30%.
Sure.
And that's just part of doing business. They're not pleasant. But on the other hand, and the problem is even the ordinary drawdowns are likely to cause anguish to your clients.
Sure.
But in terms of your system, these are pretty much, just part of the game. When you get what I call a catastrophic drawdown, say something 50% or greater, I think those are pretty rare. As I would say most, a trader might experience something like that once in 20 years or whatever. And so once again, it's just a matter of living through it when it happens. But in terms of my experience with that, no, I don't know. I suffered, but I didn't change anything. And as I say, the following year, I was up 85% or something. So to me, the existence of drawdowns, large or small, at least in my experience, have not had any particular bearing on, in other words, I don't use those as evidence that my system's not working, right, or that something needs to be fixed. And the reason for that is, as I say, I have this, I have this underlying faith, and I think faith is the only word for it, that markets will continue to exhibit persistence. That is, the trend following, is sort of a universal, or at least a persistent, if that's the word, behavior of the markets. And as I say, that's supported by the fact that the markets are subject to the fundamental economics that don't change.
Sure. Now, you mentioned also earlier on that at times where performance has been flat or slightly down, that's where you've seen investors leave, and I think that can be said for probably every single manager, in the business. So clearly, investors don't share the faith that you were talking about when they go through a drawdown. Is there anything you think we can do as managers to help them become a little bit more faithful?
Well, as I say, I think it comes under the heading of sort of customer relations or marketing or dedication. So I don't think it has so much to do with trading as it has to do with just being able to convince. And this is true in any business. You can develop your business so that you have a faithful clientele. And I think that applies to this business also. So I think the really successful CTAs have managed to develop that kind of relationship with their clients, so that their clients have the same level of belief, in the viability of their systems as they do. And that's something I haven't been particularly successful in developing, but on the other hand, it's something that I have. In other words, like I say, you talk about drawdowns. Obviously, it's easy when you get into a big drawdown to start doubting yourself a little bit. But really, I can't think of what else I'd do other than throw in the towel and go into another business.
Sure, But the other thing, and that I think is important when people look at your firm, and that is you've proven that you're not going to change, and that you have the faith, and frankly, a lot of managers who raised a lot of money are firms that have come out where it looks like this is the next great iteration or trend following we all need it. But based on a 5-year track record, you actually really don't know what the strategy is capable of doing to the downside at that stage. So, as you say, the longer the track record, the more of these drawdowns, and people might look at that as a negative. But in reality, it's probably the best thing, best evidence you can get that the manager, knows what he's doing and is capable of riding through the difficult times. So anyways, now one just final question on risk. Is there anything that keeps you, awake at night, Bill, in terms of something where you just can't model that, you can't take that risk away, or are you really that comfortable with every aspect of the system today?
No, I mean you can always fantasize on the end of the world or whatever, but no, in terms of any sort of reasonable environment. For instance, I guess an example might be, and that I've seen a couple of times, is you have something like in the meltdown in 2008. You have, or you might have a change in government policy. Oh, okay. Here's a good example: is the recent Swiss franc when they unpegged the Swiss franc, right? Well, that was a it was a big hit, right? For me, I lost probably 5% on my Swiss franc trade, but it's one commodity out of 40. So in terms of my overall portfolio, it was, I took a bit of a hit, but not much. And I've had situations in the past where something like the euro dollar is just, goes crazy, or you'll even have occasion, I think I had an occasion several years ago in the euro dollar where you had like a flash crash type of thing where in these I guess, with these electronic markets, you don't know what's going to, you might wake up and the thing's gone to zero or whatever. But I think that's where trading a number of markets helps, is that it's unlikely that one market is going to kill you no matter what happens.
I wanted to jump to a section which is a little bit, sort of more on sort of the not personal side, but as we round off our conversation, just for people to get a chance to get to know you maybe a little bit better. And the first thing I just wanted to ask you is, and this is more to talk a little bit more about sort of probably the business side of things, and that's just over the long career you've had, what's been the biggest challenge when you think back of what you've done? What's been the biggest challenge for you?
I suppose the biggest challenge is just to stay with it.
Right. The discipline,
it's the discipline. I mean, as I say, when I got into this business, and one of the attractions of this business is, one, I don't have to work hard. 2, I can live where I want to, and 3, I can go surfing when I want to.
Sure.
The downside is you got to do it every day. Somebody's got to do it every day. You can't, I can't take a month off and without having somebody else, cover it. So it's that sort of day in and day out, year after year type of thing, I think, that requires a level of persistence. And so, sometimes you just get tired and you'd like to take a break.
Take a break. Yeah, no.
But as I say, I'm sort of aiming towards retiring, shall we say, at some point in the not too distant future. So hopefully I can work something out in that regard. On the other hand, it's certainly entertaining. It's kept me entertained for most of my life. So, and it keeps me engaged in the world. I mean, the thing about trading commodities is even if you're not a fundamental trader, in terms of your technique, you have to keep track of what's going on in the world economy and the various markets, and that's interesting in its own right. So I, like everybody else, I have opinions on what the copper market's going to do or what the gold market's going to do and whatever. It just doesn't happen to affect my trading.
Maybe we should do a separate podcast for that. I should ask all people who are systematic traders what their gut feels are and what their own predictions are, even though it's nothing to do with how they trade in reality. That could be an interesting conversation.
Well, let me give you here's my main take on that, and sure. This is something I think that is that is contrary, or at least is not widely recognized, is that in commodities, people talk about commodity super cycles. Mm-hmm. These cycles last a long time. I mean, from the early 80s into about 2000, you had a bear market in commodities. That's a 20-year bear market. Then you had a bull market, from about 2000 into whenever, maybe for 10 years. And since then, we've been in a bear market. And people think, people are seem to be trying to pick the bottom in these various commodity markets. And they're certainly low now, but this could go on for a long time, just based on history.
Sure. No, absolutely. I agree with that completely. Now, you've been involved in, I'm sure, many, due diligence questionnaires or meetings, telephone calls, whatever it might be, with investors, researching your firm over the years. What do you find that investors or potential investors, what do you think that they should be asking you, but they never really do? I mean, what are the missing when they're looking at a strategy like yours?
I don't know. That's a good question. I don't really have an answer for it.
That's fine. There may not be an answer. Let's jump on to the last section. Then you can always come back to it. But the last section I have, I wanted to ask you a little bit. I call it general and fun. It's a little bit of everything sort of put together at the very end. The first thing I wanted to ask you is, what do you think it takes to become a good trader, and what does it even mean to be a good trader?
I don't know, and the reason I say that is I have friends. I have a friend who's a high frequency trader. I have friends that I read about. I read about people like Warren Buffett or George Soros or whatever. I think that there's a wide variety of possibilities in terms of trading approaches, and I think, of course, it goes without saying that people would tend to pick a trading approach that fits their personality. But I guess the bottom line for me would be discipline, and that is, I think that anyone who's a successful trader long term has developed a discipline. And in fact, I think that all successful traders are systems traders. They just don't maybe characterize themselves as that way. But I think as a trader becomes more and more experienced, he becomes more and more disciplined, and in terms of his whatever approach that he or she is using. And so the advantages to being a systems trader is that you enforce that discipline from the get-go, even though I'm sure everyone has learned that it's extremely, it's one thing to implement a system, it's another thing to stick with it. And so, but to me at least, that's easier than having to, on a day-to-day basis, sort of renew that discipline, which would be very difficult for me to do psychologically. In other words, if I had to trade, if somebody said you have to sort of trade by the seat of your pants, I'd do something else.
You would do even more surfing, perhaps.
That's too much. That's too much work and too stressful. So in one sense, the reason I trade the way I trade is it's for me it's sort of like the least stressful way to trade.
Sure. Now you clearly read a lot of books that's apparent from our conversation. In terms of trading and sort of maybe ways of improving your trading, what books would you say has been most influential on you, and that you maybe want to sort of recommend that people should read? Is there a couple that stand out, do you think?
Well, obviously, from my perspective, probably the best one would be Mandelbrot's The Misbehavior of Markets.
Okay.
Which is a really comprehensive sort of description of his, sort of research and his views. Another book that always was one of my favorites was The Secrets of Professional Turf Betting.
Okay.
Which was written by a guy who played the horses, but I mean the whole description of how the basic idea is that the form moves away from the crowd.
Right.
So I thought that was one of the more insightful books I've ever read on on trading. I mean, really lots of books. The books that I think are probably the most pertinent in many ways are books that have nothing to do specifically. For instance, the Dostoevsky's short novel called The Gambler is a good one for psychology. And it's very painful to read for anybody who trades. So I think when I look at useful, I mean, recently probably the most interesting book I've read is Daniel Kahneman, Thinking Fast and Slow.
Yeah. A lot of people refer to that.
Yeah. So I think that really there's a lot of the books that I look to for inspiration, and this has been true in terms of all going back, developing trading systems, all that tend to be outside the field. Physics books or books on, psychology or other more general topics.
Sure, absolutely. And based on everything you've learned in your career, if you were going to give any advice to someone starting out today, or if you were given the chance to start from scratch today, so to speak, and turn the clock back, but knowing what you know today, what if anything would you do differently?
Well, I think looking back, the main thing I would have done differently is I was back involved in computers in the early days.
Yeah.
If I would have focused on, say, setting up a software firm, or even setting up a firm to provide financial software, then that probably would have been a more lucrative, shall we say, and perhaps even interesting career choice.
Sure.
In other words, you take somebody like Bloomberg, he's selling the shovels to the miners, right?
Sure.
Whereas the traders are the miners. So I think that everybody wants to be a trader. I mean, trading's this exciting and
glamorous career.
Glamorous, but I tell you, the way to make real money is to be a .com,
right?
Entrepreneur. Those guys don't make 20% a year.
Sure.
But of course, they're it's a crapshoot too. Most of them go bust in a hurry. But no, I think but at the time, once again, I think the business is in a sense, it's a very seductive business. A lot of people, a lot of especially technical people, physicists or mathematicians or engineers or whatever, get attracted, and other people also, of course, but get attracted to the prospect of applying their tools to finance. And in fact, that's what I thought. When I was back working for a think tank, I was doing all this interesting mathematics, but I couldn't see. It was all a paper chase. All you're doing is writing reports. And I thought, how can I use mathematics to actually make a living? And one of the few things that I could identify, or the only thing I could identify, was applying it to developing a trading system. And I think that's changed. I think that now somebody who has skills in mathematics, there are a lot more ways that can be applied, with expansion of modeling and all sorts of different fields. But in those days, about the only kind of modeling that you could do that, had a practical application was trading the market, was modeling the financial markets.
Sure. No, that's a good point. Bill, do you have children?
No.
Okay. So I have to phrase the question a little bit differently then. If you had someone that you cared for that you could only pass on one of your skills to that person, what skill would that be and why? You can't mention surfing here.
Well, I don't know. That's a hard one to answer. Because I'm not very, as you might have gathered before, and I've had the opportunity to say encourage, younger people.
Sure.
And I don't encourage them to go into my business. One of the things that was discovered or came out during the financial crisis is that, something like 40% of the graduates of MIT and Stanford and Harvard and go to Wall Street. Mm-hmm. I think it's a gross waste of talent.
Sure.
I mean, those people should be doing something productive, right, other than just professional gambling.
Sure.
And when I got into the business, and the people in my generation, we were really unique. In other words, people, like I say, people who graduate from MIT or Harvard Business School or whatever, did not go into finance.
Sure.
That is, they went out and they ran businesses or designed, products or bridges or whatever. And so, in a sense, we've met the enemy and he is us. In other words, I feel like I was one of the original quants. Sure. And I think the world of finance, and to some extent the world, has been taken over by quants. And I think it's a waste of time and energy. It propagates an illusion among the public that the common man can make easy money, which is just not true, right?
That is true.
And so I look at somebody like, say, Fama, Eugene Fama, who has always been, in some sense, an intellectual nemesis because he's been the standard bearer for the random walk and all that. Right. But I was reading something about when he got the Nobel Prize recently, and essentially what he said is basically what he said is that most people should put their money in index funds, and I agree. I think that the financial services industry is just way larger than it should be.
Well, I think that's a fine answer. Although it wasn't quite what I meant, because in terms of skill, it could be any skill. But I'm going to try and lure it out of you in a different way by asking you whether you have a secret talent, something that even people who know you might not know about you. And again, here, I guess everybody knows you're a good surfer, so that might not be your secret. But is there a fun fact that you can share with us that people might not know about you?
No, not that I can think of.
Fair
what
enough.
You see is what you get. I'm a surfer and I'm a commodity trader, and whatever comes out of that. And of course, what I really am, I guess here's something. I mean, I've developed an interest in the last 15 years or so in physics, and particularly in thermodynamics, and that's been, that's very interesting, but it's certainly not a secret. And I find it's also something that seems to be at least not uncommon among CTAs, that they tend to be attracted, at least later in life, if they didn't start out as physicists, that they tend to be attracted.
Now, I said earlier today that, or I asked you, what investors might miss when talking to you in terms of questions. So here at the end, I'm gonna turn it on myself and ask if I fail to ask you anything that you want to bring up at the very end, just to make sure that we do justice to you and to your firm.
No, I think you've covered it, pretty thoroughly.
That's good. Now, before we finish our conversations, do you mind sharing with the listeners where they can best reach out and learn more about you and your business?
Well, I have a website, www.dreissresearch.com.
Great. So they will definitely be able to find you there. And of course, I will also put up some information on the show notes page for this episode. But I think that just leaves me to say thank you very much, Bill. It's been very interesting, and I appreciate your openness and transparent way of explaining everything you've done and shared with us today. And I hope we will have a chance to catch up at a later date and see how everything is developing on your side.
Okay, well, thank you very much. I appreciate your time.
Good. Thanks so much, Bill, and take care.
Okay, bye.
Bye.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.